You're standing in line at orientation, holding your financial aid package. It's a mix of grants, scholarships, and something called subsidized loans. It feels manageable, even optimistic, until you notice the fine print. Interest accrues immediately after graduation. But you ignore it. Everyone says, student loans are just part of going to college, right? Fast forward a few years. The job market isn't what you expected, and the monthly loan payments are starting to feel like quicksand. This isn't just a hypothetical scenario. It's the reality for 43 million Americans. The average student loan balance in the U.S. is over $37,000, and for many, it's much higher. By the end of this video, you'll know how to break free from this cycle, or avoid it altogether. But first, let's uncover why student loans are more dangerous than they seem. Quick pop quiz. What's scarier than student loans? A text from Sally Mae when you forget to make a payment. Trust me, they don't LOL. 1. The emotional burden of loans. Student loans don't just affect your wallet, they affect your mental health. Studies show that 1 in 15 borrowers experience financial stress severe enough to lead to depression. Example. Meet Alex. Alex borrowed $50,000 to get a degree in psychology. After graduating, they struggled to find a job that paid more than $35,000 a year. Every month, Alex puts half their paycheck toward loans, skipping vacations, delaying buying a car, and moving back home with parents. Alex feels stuck, like their degree isn't the golden ticket it was supposed to be. Does this sound familiar? You're not alone, but you don't have to stay in this situation forever. Key takeaway. Before borrowing, consider how debt could affect your mental and emotional well-being long-term. But it's not just emotions. There's hard math behind why loans can become a trap. 2. The financial reality of borrowing. Here's the hard truth. Borrowing $30,000 for college doesn't mean you'll only pay back $30,000. With interest, you could end up repaying $50,000 or more. Breaking down the numbers. Let's say you borrow $30,000 at 6% interest. If you take 20 years to repay, you'll pay about $40,000 in interest alone. That's a total of $70,000. And that's assuming no missed payments or late fees. Imagine working for 2 decades just to pay for something you finished years ago. But what if you could cut that repayment time in half, or avoid loans altogether? Stick with me. Spoiler alert. A degree doesn't come with a money-back guarantee if you hate your career. 3. Understanding federal versus private loans. Split-screen comparison of federal loan benefits versus private loan risks. Here's where most people make their first mistake. They don't understand the difference between federal and private loans. Federal loans, lower interest rates, flexible repayment options, and protections like deferment and forbearance. Private loans, higher interest, stricter terms, and limited repayment options. Story. Julia borrowed $25,000 in private loans to attend her dream school. When she lost her job during the pandemic, her private lender refused to pause her payments. She was forced to take on credit card debt just to make ends meet. So how do you borrow wisely, or avoid borrowing at all? 4. Loan forgiveness, hope or hype. Loan forgiveness programs sound great in theory, but the reality is often more complicated. Public Service Loan Forgiveness (PSLF) requires 10 years of payments while working for a qualifying employer. Less than 2% of applicants actually qualify due to strict rules. Income-driven repayment forgiveness takes 20 to 25 years. Forgiven amounts are taxed as income in most cases. Don't rely on forgiveness programs unless you meet every qualification. But what if you could graduate without needing forgiveness at all? Let's talk about that next. 5. Smarter borrowing strategies. Here's how to borrow smarter. 1. Apply for free money first. Scholarships and grants are the best kind of aid. They don't need to be repaid. Websites like FastWeb and scholarships.com are gold mines. 2. Limit your borrowing. Never borrow more than 30% of your expected starting salary. 3. Choose the right school. Consider in-state public universities, community colleges, or trade schools. 4. Live frugally. Opt for shared housing, meal prepping, and buying used textbooks. 6. Graduating debt-free. A step-by-step guide. If you're still in school or about to start, here's how to avoid loans altogether. Step 1. Apply for scholarships every semester. Many go unclaimed. Step 2. Start at a community college, then transfer to a 4-year school. Step 3. Work part-time and save aggressively. 7. Managing debt like a pro. Already borrowed? Here's how to take control. Use the avalanche method to pay off high-interest loans first. Refinance if you can lower your interest rate. Avoid deferment unless absolutely necessary. It just increases your balance. 8. Building wealth while paying off debt. Even if you have debt, you can still start building wealth. 1. Invest early. Start small with low-cost index funds. 2. Side hustles. Use extra income to pay off loans faster or boost savings. 3. Avoid lifestyle inflation. Keep expenses low as your income grows. By now, you have a blueprint to navigate student loans and build a wealthy lifestyle. For even more actionable advice, check out my next video. How to save $500 every month without cutting out everything fun. If this video inspired you, hit like, subscribe for more life-changing tips, and comment with your biggest financial question. Let's shape your future together.